Surya Saha and welcome to the Insurtech Story Podcast, the platform to spread knowledge on insurance innovation, digital disruptions and entrepreneurship. Our website insurtechstory.com, and we are available on Spotify, Apple and Google. Today we will discuss on the topic Insurtech, innovating for the future while managing risk today. And for now, I'm delighted to welcome our guest Matthew Quinn, who is the Chief Risk Officer at Goldner Capital Management. Goldner, a venture capital and private equity firm, is a specialist in the post-acute care market as an owner and operator of skilled nursing portfolios across the United States. It primarily focuses on buying distressed assets where the operational team presents a value-add component to the deal. In the new role, Matthew serves as CEO of Goldner's captive unit, which provides general and professional liability coverage for the skilled nursing facilities, with plans for future expansion to additional lines. Before joining Goldner, Matthew was associated with Hiscox, and prior to Hiscox, he was the general counsel at Venture Capital Management, an Atlanta-based captive manager with several wholly owned captives in Britain and the United States. So Matthew, a warm welcome to the show.
Hey, thank you for having me.
So Matthew, as we discuss today's topic, we'd like to quickly jump onto the agenda and get your views from your personal experiences and knowledge, primarily covering the insurtech and the risk management space. So what are some of the biggest risks facing the insurance industry today, and how do you see Insurtech helping to mitigate this risk? Of course, we know a lot of aspects from the macro part, from the geopolitical aspect. But anything specific that we can understand and relate how risk management and Insurtech aligns with each other?
Yeah, of course. One of the biggest issue that we see facing the insurance industry today is the inability to access the data, the treasure trove of data that exists within the claims function. And there's been some meaningful strides toward this, but the ability to automate claims is very, very near. In terms of workers' comp, a firm called Gradient AI has gone a long way toward automating claims. One of their things I think is cool is that they can identify what they call a creeping cat within days instead of weeks. So it'll take a qualified adjuster, not just somebody off the street, somebody with some experience, several weeks to determine if somebody's injuries are going to manifest into a medical scenario requiring ongoing surgeries, multiple surgeries, lots of expensive therapy. And the AI, Gradient AI, is able to identify that in days. As a result, before the plaintiff's attorney even realizes the value of the case, the adjuster could be offering something that appears fantastic, gets the case settled real quick, and cuts off the medical liability, which ends up frequently being more expensive than the indemnity, at least in workers' comp. So you've got a real push in that area of casualty. I see similar opportunities in general liability because of the roteness of litigation. One of the things I don't think people fully appreciate is just how similar slips and falls are across all 50 states. There's a tremendous amount of work from the drafting of the answer to the legal research, the production of a motion for summary judgment, the production of discovery documents, responding to discovery complaints. A lot of that can be automated. And there's some software in place. One in particular I like a lot is called Case Glide, that assists with litigation management in a very sophisticated way, giving you some details, at least at the managerial level, with regard to the spend in cases, the efficiency. And that's the kind of player that will eventually be able to automate a significant chunk of what's going on. And I don't know if it'll be Case Glide or it'll be someone else, but the way you do it is you got to have thousands upon thousands of complaints and answers and adjusters' notes and settlements so that you can start to forecast out how the complaint or how the case is going to go. And there's a lot of variation between states. So, the value of a case in Fulton County, Georgia is going to be wildly different from Broward County, Florida. So you've got to accommodate for that. But the carriers have that data. You look at someone like Allstate, you look at someone like Nationwide. I mean, these guys have millions of claims, probably in every single state. I mean, people don't realize just how frequent litigation is in the USA. So the breadth of data exists. And another thing that is fascinating about focusing on claims is that nobody has claims data. If I were to ask you, go out and get me a whole bunch of claims data, you would come up short. There's only three parties out there that have claims data: A, carriers; B, third-party administrators; and C, law firms. And the carriers, admitted carriers in particular, have been slow to join the data science revolution. There just hasn't been enough market pressure to force them to do so. So while they're doing some reasonably decent analysis, and in some places great analysis at the managerial level, you haven't seen a real push to try to reduce the allocated loss adjustment expense through automation. ALA, by the way, allocated loss adjustment expense, broadly encompasses all the fees you'd spend on expert witnesses, defense attorneys, all the fees of a case that are variable. And that's a material chunk. I mean, if you think of premium, you get 100 cents on the dollar, 12 to 15 cents per dollar of premium is going to go to allocated loss adjustment expense. So if we could automate a significant chunk of casualty and drive ALA down to a fixed cost, then all of a sudden you're talking about 7-10 basis points of additional profit on your combined ratio. That's real money. So there's definitely an opportunity. Haven't seen a lot of people going after it. The third-party administrators are no better. They have not done a meaningful job in this space. And the law firms are the worst of all. They have absolutely no market pressure to get efficient. They bill time and expense. There's not one single law firm that has taken a real running start at trying to crack open their data. That may be a misstatement. I think there's probably a few, but for the most part, there's no legal tech out there that's really tried to automate the process of defending cases. So that to me is a risk, because if it can be done, it will. And where I see it probably coming out is some of these newer startups, Lemonade, Root, Metro Mile, the Insurtech 1.0, and then the new MGAs that are coming on board. They're building from the ground up. They're looking toward automating as much as possible. And their Achilles heel is, even if they build it, they don't have enough data to get meaningful results. But it's my anticipation that this second wave of Insurtech that we're kind of we're graduating into, it's going to have someone come out that's going to radically change the nature of claims, and that will be the market pressure that causes the legacy part of the industry to change its ways with regard to data and claims.
Right. So, if I can get the gist out of this, so safekeeping of data is the foremost risk that the industry would face, or rather is facing at the moment as well. Is that right?
The safekeeping of data is a huge concern for anybody who's related to the healthcare field. It's also a concern for everyone else, especially with regard to the exposures from hackers and the whole cyber space. But in particular, it is extremely important that anybody affiliated with healthcare,
right.
The HIPAA in America is such a powerful force of law where if you accidentally allow the healthcare data to be spilled out, then you could be found liable for a whole host of fines and penalties. So there's no joke that the safekeeping of data it's a paramount concern. I would say that data in general is so valuable that every organization needs to have a robust process to protect it with all reasonable means, because I don't think the courts are going to be particularly sensitive to arguments saying, oh, well, the hackers came in and, they stole our password or they had some phishing attempt. At this point, it's 2023. Cyber liability has been around since at least 2010 as its own thing, not just a throwaway on a property form. It's its own policy. So there's a bit of cultural awareness of the sensitivity around data that just wasn't there 5 or 10 years ago.
Yeah, it's interesting to see. I mean, Insurtechs, how they are actually innovating, moving with technologies to help incumbent insurers and other, the client side of the business to provide protection coverages against cyber threats, and they themselves are also, uh, kind of need protection for such sort of a threats, right? So
Right. That's exactly right.
so that goes like, both ways on how the insurers and insurtechs are at the center of everything, for themselves as well as for their clients, because they are handling data not just theirs but also the financial data of their clients. And being in the financial services, as you mentioned, data is actually the most important asset that they have. Moving on to the next part of the discussion, Matthew, with the rise of insurtechs, how do you see risk management practices evolving in the industry, and what new risks are emerging, and how can they be managed effectively? Of course, you have mentioned the biggest risk, but it would be great if you could, highlight something on how they can be effectively managed.
So risk management is traditionally just a throwaway box that you check on an application for insurance, and then nobody really audits it on the back end. And that paradigm has fallen away in the field of property insurance. And what we're seeing now is meaningful follow up with the carriers to assess that you have the things in place that'd be necessary to preclude wind damage, hail damage, anything else that's generally avoidable. You're seeing a rise of flow valves being installed by insurance companies. Part of your premium pays for these things to reduce water leakage, to monitor flow, to make sure that it's more efficient. So risk management has now moved from a nice thing to have into a critical part of pretty much every new insurance program. So property has declined to accept any more risks than it has to, and it's pretty significant what's occurring in the property space. You look at Florida. If you have a building that's over 25 or 30 years old, it's a good chance it's uninsured, because the cost of insurance in Florida is so incredible that most people are just finding it to be unaffordable. Banks are even starting to waffle a bit on the requirement for a total insured value on a property. The cost of a wind coverage is so high in Florida that they've been allowing homeowners to sit there and insure to less than replacement cost with regard to the wind damage that could occur in a hurricane. So the focus has now shifted from just taking rate and trying to charge expensive insurance to taking rate and trying to manage the frequency of claims. So where I see this going in terms of Insurtech is any MGA or any Insurtech of any kind that gets up and running is going to face a real inquiry from investors in terms of how does your special thing reduce the frequency of risk. So if you can reduce the frequency, you're probably going to reduce the severity as well. So show us that by working with you, that we're going to really reduce the numbers of times that we're going to have to pay claims. That is a sea change in terms of the perspective. Because traditionally speaking, you buy the insurance. If you have a claim, the insurance company handles the claim however they handle the claim. Then experience the wonders of a rate increase on the back end. But that just is not feasible right now, because insurance is so expensive that when people have claims, increasing the cost of coverage is pretty much, I mean, in many cases, you're just going to lose the account. So we're facing a bit of just market pressure here that just really needs a less litigious and an overall safer environment.
Right. So do you think captives can play a major role here?
Absolutely. So not only can captives provide for self-insurance solutions, but they also provide the engine for MGAs to get off the ground. So if you have some sort of
Right.
a new uh, technology you want to roll out and encourage some reinsurers to start a new program, the captive insurance company puts skin in the game. So you'll
Yeah.
take, some chunk of the risk, either on a quota share or excess of loss basis. And all of a sudden, you now have marketed yourself as someone who believes in your own product. Um, in addition, captives are just a phenomenal way to actually purchase meaningful risk management technology. If you build into the cost of premium a certain amount of stuff. So, let's say the premium is going to be, $10,000 for the year to cover something. And at the end of the day, you can work with the actuary and just allocate maybe $1,000 or
True.
$500 for
Yeah.
whatever hardware or software that will help you to reduce the frequency of risk. As a consequence, all that premium you had that is now not being used as claims ends up becoming surplus underwriting profit. And obviously, you can do whatever you want with that money. So, yes, I do see captives as a meaningful part of the solution.
Yeah. But the only challenge that I see with captive is with the adoption of it. Of course, it's not a very new concept, but it's getting into the limelight in recent past, particularly from the United States and the other North American places. However, if you look at the Asia Pacific region, its captives are hardly seen. I mean, even though insurers, incumbents, and even other businesses who may find uh, getting a coverage from a third party insurer to be expensive, they are still not, maybe lack of awareness, or perhaps the cost part of it, or maybe any strategic aspect. So captives are really not in existence in the Asia Pacific region as of now. So I think worldwide that can be one, a great solution as you mentioned, but again that can give a great competition to the incumbent insurers as well, and even the reinsurance companies.
Yeah, I'm glad to hear you say that because I haven't heard of many people working in captives in the Asia Pacific region. So I didn't know if I was just out of the loop or if they just aren't relevant. And I'm not surprised. It took captives a very long time to take hold in the United States. They were invented sometime in the 1950s, and they faced incredible hurdles in every direction from the IRS, the legacy industry just not wanting them, brokers not understanding them, the insureds not understanding them. I would argue they didn't really become a meaningful part of alternative risk financing until about 2010 or 2012. Then you did see a bit of a blossoming in captives through the mid teens. They came back a little bit in 2017, 18. There was a bit of a dip in the industry, but now they're roaring back now that we're in a hard market as a meaningful part of the risk financing strategy. And I think that the captive solution is so malleable that we can talk for hours. You can do a large deductible, lower your cost of insurance significantly, but put that deductible into a captive. So now you've got the funds set aside in the captive, but you got that nice big fat tax deduction on the front end by paying the premium to finance all those deductibles. And there's plenty of companies that do that. Plenty. Every Fortune 500 company does exactly that. Um, Captives can insure uninsurable risks. So, you got something out there, it's a novel risk, it's a new invention, underwriters have never heard of it before. That's where a captive shines. And there's all sorts of other uses. Some industries just really struggle with commercial solutions all the time. The PEO industry, skilled nursing, commercial truck, those are three that just traditionally have struggled. And captive solutions are great for them. I assume in the Asia Pacific region, there are any number of types of companies that range from shipping and transportation to mining that probably struggle with commercial solutions, or they just pay way too much money for insurance, for whom captives would be a fantastic deal.
Yep, absolutely. Moving on to the last part of our discussion today. How do you balance the need for innovation and agility with the need for risk management in the insurance space? Any best practices, that can ensure that insurers and insurtechs are managing the risk effectively while also pursuing innovation and growth? Any thoughts on that?
Well, risk management is innovation. So when you're managing the risk, you're managing your business. And the best risk management strategies are seamless, cost free, and do not interrupt the value out of what you're doing. Those are really hard to find, by the way. So, where risk management needs to start is from the value that whatever the company is doing. And then from there, figure out what things are getting in the way of that value. So I hate to sit there and boil it down too much further than that because I'd be giving away some of the secrets to what we do to manage risk in healthcare. But effectively, the heuristic you should be looking at is, okay, where are the problems occurring? Well, everyone knows that. You had a slip and fall here, you had an accident over there. Okay, well then you just need to, you kind of got to go backwards in time and say, okay, well, what led up to that? And was there like some sort of a failure in safety? Was there a failure in training? What was going on? And then you just have to kind of reverse engineer to start to find all the critical points. If you could almost like process flow chart how value is created in the firm, and then look at all the critical points where you could do something safer. And then you need to focus in on those areas and say, okay, what's it take here? Do we just create a report for the floor manager and say, hey, here's some things that are going on? Do we hand everyone a hard hat? I mean, obviously, every industry is different. So the risk management for Microsoft is going to look completely different than a construction company. So I hate to be so general, but I don't want people thinking that risk management is as simple as just telling everyone to be careful, wear nicer shoes. Like, no. That's not what risk management is. Risk management is finding seamless manners by which to reduce the overall cost of risk in a company and thereby improve the bottom line, the operations, and the efficiency of what you're doing. Make sense?
Yep, absolutely. Just to add to your points, I think a couple of the best practices that industry must look at is, of course, to start with, is to have a strong risk management framework. Where Insurtech should have a robust risk framework in place that includes identifying, assessing, mitigating, or even monitoring the risk. Right. Uh, another couple of points can be incorporating the risk management, kind of into the company's culture, and ensuring regulatory compliances. And the most important, part is invest in technology and use data to drive risk management decisions. I think these are the 2 points, of course, you have touched upon in the previous discussions. So these can be, just to add to what you have just mentioned. So do you think this also can be a valuable addition or what Insurtechs or an insurer should look at?
Yeah, so I look at Insurtech as the innovation that I was describing before.
Right.
So when an Insurtech shows up, it needs to be the solution. You should be plugging and playing into an operator's operations so that you provide value from day one.
Right.
In a way, the insurance is really coming along for the ride. You need to have a solution, whether it's software or whatever it is, that meaningfully reduces the cost of risk. And then at that point, the insurance is just, that's just the moneymaker. You'll be making money, through the captive, through the fronting fees, through the commissions, through the MGA, however you structure it. There's a million ways to structure it. But the key thing to remember is that Insurtech only flies if it's reducing the cost of risk. Because if not, why would they use you? Why would they use any Insurtech? Just use a legacy carrier. Use just a normal out-of-the-box solution, just some whatever company, it'll be, AM Best rated. They're all fine. There's nothing wrong with the legacy carriers. The Insurtechs only really fly when they're cheaper. Let's cut through the BS. Insurtech can only really be a viable solution if it's cheaper. And the way you get cheap is if you substantially cut the cost of risk. And that's the complexity. Just showing up with Insurtech 1.0 was neat, where you had these people with, apps that could, help you sell insurance more efficiently, direct to the customer. That's wonderful. Those things are all wonderful. They're incredible value adds. But this new phase of the industry is not going to reward anybody who shows up and does business as usual, but kind of sort of like a tech company. No, you have to be solving a problem, and I think that's the fundamental thing. So industry specialists are necessary. So okay, if I were investing in an Insurtech team, the first thing I want to see is, okay, what industry are you going after, and who on your team knows that industry backwards and forwards? If you're just a bunch of tech bros and insurance guys, and you're showing up with this great solution, I would immediately run for the hills. Even if what they do works, you need to have that insider knowledge of how to implement, and here's the key thing, implement and then use. So, I mean, who cares if you have the world's best Insurtech? If nobody's actually using it, the insureds aren't actually using it because it's either a pain in the butt, it's really complicated, it just doesn't fit with the operations, it sticks out like a sore thumb. Well, bravo. And, you sold some insurance, but you're not going to be profitable because as soon as those costs start coming in, the Insurtech will become unprofitable. Insurtech has a meaningfully higher expense ratio than pretty much any other startup in the insurance land. And the reason for that is that tech, whatever it is that you're doing that's so special, it has labor, it costs money, there's developmental costs you have to spread out over time. So if you're paying out a whole bunch in claims, there's no way for you to make a meaningful profit. And I'm also not particularly thrilled when people just show up as an MGA. If you're an MGA taking zero risk and you're going to lay off everything to the reinsurers, I mean, whatever, you can get away with that for a while. But the reinsurer's veto is no joke. And capital was a hell of a lot easier to get 4 or 5 years ago than it is now. So if you're showing up without a captive, you're going to lay off 100% of the risk, and you're going to make all of your money on the front end through commissions, then expect to have a bad time.
Yep. I think you have mentioned a very valid point here is the cost of the price. And that's going to be sensitive for any businesses, and especially in the insurance field, be it customers or the insurance companies or any other vendors or middlemen. And fantastic. Lovely discussion, Matthew. Thank you so much for sharing your thoughts today. A true delight to have you as our guest.
Thank you.
And last to wrap this up, thank you for listening and see you at our next episode. Take care and stay safe. Goodbye for now.